We have short, long-term impact of COVID-19 on real estate. And I want to welcome another member of FLIA, Nick Neri from Circle Partners. He's going to moderate and introduce the panel today. Nick, are you with us?
Yes, Mike, I'm here. Can you hear me?
Nick?
Mike, can you hear me?
How come I can hear you both?
Hello?
Okay.
Mike?
Yes, I can hear you now. Thank you.
Okay, terrific. Thank you very much. So good afternoon, ladies and gentlemen. I want to obviously welcome everybody to the Real Estate Direct Lending and Private Debt Forum 2020. Obviously, as Mike mentioned, this session is going to specifically focus on short-term, long-term impact of COVID-19, specifically on real estate. Before I begin, I also want to wish everybody attending, their family, their friends, obviously coworkers, our country and the globe, obviously the best of safety and health during obviously these challenging times. Also want to just thank Mike Corselli, his team at Flyer, and our sponsors for putting this great event together. Over the next 60 minutes, I would encourage everybody attending to utilize the chat function. Please ask some questions, be as interactive as possible. So everybody, welcome. My name is Nick Neri. I'm the Vice President of Circle Partners. We're a global fund administrator based out of South Florida. I have the distinct privilege of moderating today's panel discussion as mentioned. I've been working in the financial service industry for just over 25 years with a specific emphasis on traditional and alternative investments. Prior to joining Circle Partners, I was the Chief Operating Officer and a partner at a boutique fund administrator based out of New York, where I was actually born and raised. And back in 2016, sold my ownership to a publicly traded company, which was focused on administration and looking for a U.S. presence. And then in 2018, had the privilege of relocating to South Florida, where I am now. And I presently oversee North America and Cayman Islands for Circle Partners. So for those of you that don't know about Circle Partners, let me just give you a quick overview. So we were established in 2000 by 3 senior executives that spun out of Citgo. Presently, we have about 10 offices in 8 different countries across the globe. We have about 140 employees also. We support open and closed-ended funds, and we support most strategy structures from a global perspective. With that, we also utilize some of the most robust technologies in the industry. We support cash management functions, AML, some KYC, all the investor relations, tax and audit prep, and we truly try to become a partner of each one of our clients. Mike, can you move to the next slide, please? So this will give you a little bit of a breakdown of who we are, what we do, and I kind of touch base on most of it. But more importantly, without further ado, what I'd like to do is introduce the really talented group of panelists that are, I would say, true resident experts within the field, and allow them to introduce themselves. So I'm going to pass it along to Ernest Johnson of ApexOne Investment Partners.
Great. Just make sure everybody can hear me. There we are. Great. My name is Ernest Johnson. I'm a partner and executive managing director at ApexOne Investment Partners. We specialize in investing in workforce, lifestyle housing, and some student housing. And I put this slide up first to, I think there's a lot of confusion in terms of what workforce housing is and where people live. And a picture's worth 1,000 words, and we don't have time for 1,000 words. So these are typical of our communities that we own. Many are in the Florida area. If you can hit the next slide, please. As you can see, we've acquired quite a bit of real estate, about $11 billion. My partners and I, that's not within ApexOne. I put that at the top to let you know my partners and I have about, there's 5 of us, about 150 years of experience. So we've seen a lot of ups and downs in this industry over the past 40 years. And while every one of them has been different, we learned something from each one. And the first thing we learn is not to panic to have a good team in place and to keep looking ahead, and that's what we do.
Play Led Zeppelin radio.
We've acquired 43 properties in the 3 funds at a value of about $1.2 billion, have about $350 million of assets under management. You can see our returns at 28% in funds 1 and 2. We historically have been paying about an 8% yield. We also pay our investors on a monthly basis, and we've been maintaining that for a number of years. If you can hit the next slide, please. This is a breakdown of our 3 funds. Funds 1 and 2 are closed. Fund 3 is still open through the end of May. As you can see, we've grown each fund significantly as we've gone along. The one item I would want to point out, the second column next to last line, you'll see Fund 2 is averaging 27.6% return on investments. I'm pleased to announce that we actually sold 2 of these properties the week before last, right as this pandemic was hitting. And I say that not to brag on our numbers, but to point out the stability of the multifamily sector. I believe in Maslow's hierarchy, and physiological needs come first and safety and housing come second. And I think that's being proven in this sector. Next slide, please. And this is just for historical reference that you can see we have had an increasing curve in terms of acquisitions that we've been making since we started the company in 2012. We will be announcing a 4th fund shortly. That's going to be a distressed and opportunistic fund because we think there will be some fallout in this sector. And we look forward to working with the investors on that as well. So, Michael, thank you again very much. And I would echo my other panelists' comments that we hope everybody is healthy and safe and continued good health to you in the coming weeks, months, and years. Thank you.
Ernest, thank you so much. Appreciate that overview. Chris, why don't Chris Innes from Dream America, why don't we move to your intro?
I spent 25 years in banking, Salomon Brothers, Bank of America, BNP Paribas. I left banking in 2017 to focus full-time on developing my company, Dream America. Also been an investor and developer of residential and commercial real estate since 2000. So just as a quick recap, why do people invest in single-family rentals or SFRs? It's become a big space since the last crisis when a lot of institutional money came into the space, ostensibly first as a trade to buy distressed assets, but then over time people realized there was actually a business here in managing single-family rentals. The things that make the space attractive, there's an attractive yield with an opportunity for price appreciation for the investors. The rental demand for housing remains strong. As Ernest was just saying, there's a shortage of workforce housing. That's definitely a trend that we capitalize on in our space. And as we head into a recession here, rental demand increases in a recession. Obviously, if fewer people are able to buy homes, more people are renting. It's a defensive asset class. Rents are sticky. Home prices may go down. Rents tend to not go down, or certainly not go down as fast as the home price itself might. In times of stress, again, this is rebounding on a point that Ernest made, tenants are going to prioritize their rent payments. Where they live is important. Now, obviously, if everybody's unemployed and they don't have income, that doesn't mean they're always going to be able to pay their rent, but they are going to prioritize that over other payments that they may need to make each month. Despite the institutional capital that's come into this space, this is still a highly fragmented market where you are competing generally with mom and pop investors who own 1 to 3 rentals. I think that maybe less than 20% of the housing market is owned by single-family housing market is owned by institutional investors. Still a lot of small landlords. So with that being said, we developed the Dream America program and what are some of the advantages versus a traditional SFR. We run a rental housing program for tenants who actually want to buy the house back from us. So they're going to go out, we're going to pick a house that they want, they're going to pay a rent to us, and then as soon as they're mortgage ready, they'll buy the house. It gives us several advantages from a defensive standpoint in that we've collected upfront cash from the tenants that's much greater than a security deposit. On average, that upfront payment is 4 months of rent. We are generally getting a cap rate that's a couple hundred basis points better than you might get on an SFR. Our clients are more focused on the prospect of buying in the future than the rent that they might be paying each month. And then the last two things I want to say about it is our maintenance costs are considerably lower than a traditional SFR landlord, in that our tenants are viewing the house as their house, though they're not the legal owners. They intend to buy it. And so they're really responsible for routine maintenance items, you know, a broken appliance, leaky sink, whatever it is. They're not calling us. These are things they're handling with themselves as a new homeowner would. And then lastly, one of the real advantages we get here when the tenant buys is that we're not paying that full retail commission that if you just went and bought SFRs on your own and sold them, you're going to typically wind up paying a 6% commission, which, you know, despite price compression you've seen in a lot of financial products, that's something that has continued to persist. So that's the biggest cost in buying and selling the homes. When we sell directly to the tenant, we skip that. So I'm not going to go through the numbers here on the third page. You can take a look at those later, but this really just shows when we're adding a new house to the portfolio, how we price in a 14% unlevered return between the rent, the onboarding fee, and then the markup on the home when we sell it back to the tenant.
Terrific, Chris. Thank you so much for that overview. I appreciate it. Let's move on to Mike Mangione of Group RMC, Director of Family Office and Advisory Relations. Mike?
Do you guys hear me now?
Yes, Mike.
Okay, perfect. Okay, well, thank you very much for your time, everyone, and thanks a lot to Flya for setting this up. Essentially, Group RMC is a family office co-investment group. We essentially get together and buy high-income producing real estate, particularly in office, particularly in the Midwest. We're considered a liquidity provider to very large institutions like Blackstone and Honeywell Pension Plan and Northwestern Mutual. And we often buy from end-of-life funds where, you know, you may have a fund that has a 5, 7, or 10-year fund lifespan. And at the end of the term, they absolutely need to be amalgamated to collect their performance fees and their IRR, and they need to sell. But not many people show up in very large office space markets, particularly in the Midwest. So we look for Class A, 8 to 10% cap rates, very high income producing, corporate tenants, institutional quality tenants. And we're just, you know, co-investors and family offices that team up together. And together we have the firepower to buy from very large institutions, large portfolios at extremely attractive pricing. So next slide. So essentially what we're looking for is cap rates on in-place NOI, so not on pro forma, because we don't want to bank on, you know, some business plan that, you know, if that happens, great. If it doesn't happen, then we have to restate everything. For us, it's all about in-place metrics. So cap rates of 8 to 10%, that's your yield before putting on a mortgage. So you can imagine once you do put on a mortgage, your distributions are quite attractive. We want to buy at significant discounts to replacement costs. Now that could sound a little bit cliche, and a lot of people say this, but it's extremely important in the Midwest where, you know, there's a lot of land. So there's always a theoretical lurking contractor willing to build a brand new building next to yours and take your tenants. But if you buy at a basis that is about 50% cheaper than his basis, or a contractor's basis to build the same building, or in other words, if you're buying something for $100 a square foot, and the contractor would have to pay $200, $250 a square foot to buy a similar asset, your basis is so low that you'll always be you'll have an advantage from a cost perspective. But more importantly, in these markets where we would charge between $20 or $22 a square foot in rent, the new contractor would have to charge his tenants $30 or $35 a square foot in rent. And in these markets, that just doesn't work. The tenants wouldn't absorb that cost. And so there's no new supply in these markets, or very little. And so big barriers to entry of new construction. The last thing is in real estate, this will apply to everybody on the panel, but your number one risk in real estate is obviously occupancy. You know, you do not want to lose tenants. And so it's very important to, just like you guys want to diversify your portfolios. I myself, as a limited partner and investor, when I buy a piece of real estate, I always want to make sure that my tenants or I have a lot of diversification in the tenant composition of my portfolio. So traditionally, we don't want to have one single corporate tenant have more than 10% of exposure concentration in a building. It's a risk for the landlord if it's too concentrated, but it's also a risk for the lender. When they're going to underwrite your deal, they're going to see it also as a higher risk, and when they see a higher risk, they increase the interest rate on your loan, and that completely changes the fundamentals of your underwriting. So the last thing that we're looking for, obviously, is very strong cash on cash. We like to invest in properties that send quarterly distributions and checks in the mail or wires. So that's what we're looking for.
Mike, thank you very much.
Yeah.
Go ahead, Mike. Continue.
Yeah, and the last thing is just a little bit of background on us. We are one of the largest landlords in Kansas. We're one of the largest landlords in Columbus, one of the largest landlords in Memphis, and I think right now we're the third largest in Indianapolis. We have about 17 million square feet in office. We're $2 billion in assets, and we have about 200 properties in 12 different states. And that's it.
All right, Mike, thank you so much. Appreciate that. Let's move on to Dr. Sanghani, co-founder and chairman, Encore Enterprises.
Hello?
Hello, Dr. Sanghani?
Yeah, can you hear me?
Yes, we can hear you. Go ahead,
okay,
please
good.
proceed.
Yes, sir. Good afternoon, everybody. Wonderful presentation by the co-panelist. And here I am, such an oddball. I'm a cardiologist by profession and developed one of the largest cardiology practice for the size of the town I was in the entire country, and then went into real estate. I don't have any degree in business, nor do I have any prior experiences in this, but I came with a street awareness from India, and with street awareness and finding the right group of people to work, we created a company called Encore Enterprises. We are in business now since my first deal was 1991, and then we formed Encore Enterprise in 1999. And we can go to the next slide. And our edge is that the usual funnel that you usually see, we are slightly different. We have a total control on every stage of the process. We are vertically integrated, and at this point we have about $1.5 billion worth of assets that we own and manage. Some of them are 100% owned by us. Some of them are syndicated. We were fortunate enough to exit the market in 2007 before the collapse occurred by selling to one of the big institutional banker in mid 9-figure numbers of our hospitality portfolio. And we were, again, whatever you want to call luck, smartness, somewhere in between, or just street awareness, we sold a significant amount of, again, somewhere in the mid 9-figure number, again, this time in the last 2 quarters. Our last closing was done last Thursday for multifamily that people were hard on with about $1 million, and they didn't have any other option but to close. So we had a good opportunity. So we are now sitting on a significant amount of cash, and we are looking for deploying into various opportunities at this point. The primary focus at this time is multifamily and hospitality. We believe that unless the CMBS debt is taken care of by the government, which we hope they do, there'll be a lot of fresh blood in the street. And some of the deals that I've been hearing what Blackstone is doing and Oxif has been doing, I think some of them will trickle down to us too. Multifamily is our backbone, and we continue to develop across the nation. They have about $300+ million worth of development of multifamily going in. We are arguably one of the largest HUD borrowers in the entire country for the market rate multifamily development, and it has been a very fruitful venture with interest rate sub 4, non-recourse, 30-year, 40-year fixed. And if the interest rate goes down further, you can refi, but interest rate cannot go up. So it's hard, and they can lever up to significant leverage that you can put if you're comfortable with it. So we have a very good business plan going forward, and then looking forward to again utilize this opportunity in this difficult situation that we all are. No investor has ever lost money with us. In fact, no investor has ever gained less than double-digit return in the entire history of Encore with 20 plus years. And overall in our portfolio, we have gross returns of 54% over more than 100 plus transactions across the board. So here you're looking at a cardiologist in real estate, and however you want to characterize, we've been very fortunate. Thank you.
Dr. Sangani, thank you so much. And gentlemen, thank you for the overview. Appreciate that. So let's get right into it. We have a bunch of questions that are coming in. So I know that this could be somewhat generalized based on our sector, but let me throw this over to Ernest and then the rest of the team. What are the short-term and long-term impact of COVID, facing in the real estate market? So where do we think that not only the market is in the short term, but necessarily going to be in the long term? And I know that's a broad question, but feel free to.
Yeah, thanks for that. When you say real estate, there's a lot of sectors out there, and I'm going to focus mainly on the living sectors in these comments. I would say as an aside, though, that I think the demise of office space has been highly overstated in the marketplace. I know when my neighbors and I gather outside for our cocktails, where we stand on a corner of the street, the resounding consensus is we can't wait to get back to the office. And I hear more and more people saying that. We're basically pack animals, and we want to be back there. Maybe we'll work at home a little more, but I just want to say, it's not my sector, but that seems to be a popular topic that I'm not sure is going to pan out. In the living sectors, multifamily apartments, again, as I mentioned earlier, when times are tough, I think we look at basic human psychology. And first and foremost, what people do is they take care of their physiological needs: food, water, warmth, rest, and then they look for safety, which is housing and security, et cetera. So I think we're going to continue to see high demand in housing. I think what we are going to see, and I hear this from other economists I've been listening to, is the challenge that's facing households is going to continue to rise. The people that have been planning on buying homes probably are not going to have the down payment because of losses in the market. Credit underwriting has tightened considerably, and it's going to be harder for them to get loans. So I think you're going to see people moving more and more into multifamily. I think a lot of that is going to sift into the workforce housing sector. Our average rent is about $1,100 to $1,200 a month. That's very affordable. I think a lot of people have gotten out over their skis a little bit. Maybe their housing costs are in their 30 to 40% of their gross income, and they're going to need to manage that down a little. So I think that mid-level housing and workforce and is going to do well through this. I think in some of the other sectors, such as student housing, we need to wait and see what the universities are doing. We have a huge reliance on foreign students, especially from China, and that's going to impact enrollment. But I think as the job market slowly recovers, I think students are going to look at remaining in school, or maybe those graduating that don't have a job are going to look at the universities. I think the small private universities are going to suffer, and I think that's going to drive some of them to closure and move more students to the big public universities. So I think we'll be doing okay there. Care and senior living, I think, was struggling before, and it's going to have some real problems. And I think co-living is one that's up for debate out there. So. I think in the short term, there's going to be some rough roads, but I think over the long term, I think, multifamily is going to come out of this very, very well.
Ernest, appreciate those thoughts. Chris, what about yourself? What do you think about the short-term, long-term impacts?
Yeah, the short-term question is how many people are not going to pay rent? and what kind of pressure is that going to put on landlords if they're not able to, whether that's a residential landlord, a commercial landlord, or otherwise, if they're not able to get some relief from their lenders. So that's a question mark. From our side, that was fine last month, but this is far from over. So we're just going to have to see how that pans out. I made a comment on the slide in terms of SFRs. I don't see a fundamental shift. Obviously, the value of housing is tied, like everything, to jobs. So if there's a lot fewer jobs, there's a lot of different areas of stress in the economy, but I don't see a need to redesign the way an SFR works, or even the way that most workforce housing works. The caveat I would give on multifamily is if you're in a big apartment building, it's a tower, I think there is going to be pressure on that. I don't know that that's going to be as attractive to live in that, and that comment carries over to student housing and senior living as well. I mean, all of those things are very similar to a cruise ship. You have people living and maybe even dining in a very close proximity to each other, and I just think that's going to be less attractive in the future. And you can certainly design new buildings in all those sectors that would address that. How the existing facilities are repurposed is a question mark. So I think that's going to be a question mark for investors.
Terrific. Thank you so much, Chris. Mike, what are your thoughts?
Well, my thought in terms of real estate, it's the second largest asset class in the world, and the first largest asset class is a debt market, of course. And usually you don't buy real estate all cash, and so the first and second largest asset class are intimately tied together. And why I'm saying that is as you can see on the panel, real estate comes in very different shapes and forms. Multifamily is very different than industrial, which is very different than self-storage, which is very different than medical or office or industrial. I know that in particular in office, I've been talking day in, day out. Our team has been talking with the property managers, with leasing brokers across the portfolio. So I want to share a couple of insights from the trenches. One thing that I thought was interesting with COVID, and we found out recently, was, and by the way, I'm Canadian. We have an office in New York and in Columbus, Ohio, but I'm from Montreal. And as a Canadian, I'm very impressed with the U.S. 3P program. From what I hear on the field, it's extremely easy to apply, and the loans, which are already at a low interest rate, actually become a forgivable grant. So it's given free money if it's used, if an employer of a medium or small business, which is about 500 employees or less, uses that money to pay for salaries for their employees or for rent. And that second part, the rent part, is huge for landlords in real estate. And so I thought that was very interesting, and a lot of our tenants have been, giving good feedback. And not only is the U.S. program or the federal program very big, and there's a lot of money being offered, but it's also very easy to apply for. So just something to keep in the back of our minds for coronavirus and COVID situation. Now, I want to also remind that this is also very new. It came up kind of out of nowhere, out of the blue, and we have particular data points which are super important, and we're still working through those. For example, we in our office space across our 2,000 different tenants, we collect most of our rent in the first 15 days of the month. So you collect April rents in between April 1st and April 15th, and then May is another huge data point, and June is another big data point. I can tell you, and I'm relieved and happy, that rent collection has been better than expected, but that's the April data point. Now I'm happy to update you next time for May and going forward that way. So I just know what I know. I can't really look in a crystal ball.
Mike, thanks for the insight. You give a really good overview also when you talk about the PPP program, and that's obviously on everybody's mind. And when you think about the governmental program, it's a great program that enables those folks that are renting to be able to provide economies that will enable them to stay within those housing structures. So we do have a couple questions that came in, and Dr. Singani, I want to also propose that same question to you, about the short-term and long-term impact of COVID on the real estate market, but also maybe you could add in and what your thoughts are on evictions or moratoriums There's a couple of questions that came in on that, and we touched briefly on it, but I don't know if you have any specific thoughts you could add. Dr. Singani?
Yeah, can you hear me?
Yes, I can hear you now.
Is this better? Hello?
Yes, we can hear you.
Can you hear me?
Yes, Doc.
Okay, sorry. So let me first address the eviction part, which is easy. Most states in this country, we will not be able to evict anybody on the multifamily side for somewhere between 60 to 90 days. And that has caused problems one way or the other. It's meant for goodwill, but some people would just probably take a different approach and just say, if I don't have to, why do I want to pay? So only time will tell how that approach is going to work out for the owners. Going back to the short-term and the long-term consequences, we only do Class A multifamily. So what has happened for us is the last cycle, our rents collection is about 95%, and we own a few thousand units. So, and the reason we believe that we have not been impacted as much as anybody else is most of our people are either professional or high class employees or executives, and hence they are least affected. What is most affected is the consumer-facing businesses. So if you look at restaurant, look at the hotel, all the lower-paid jobs have been eliminated to almost to 95% extent. So I think and those are the people who normally are not at the Class A multifamily. So we are very fortunate that even during this phase, we have done fairly well. Leasing, we are only doing virtual leasing. We have locked down our main places where people can come and visit our people, but we do it all virtual leasing. And that hasn't been too bad either. So we are very fortunate on that side. On the hospitality side, unfortunately, the occupancies are ranging between 5% to 15%, which is absolutely nobody can stay business with that kind of situation. So short term, yes, multifamily is flying high. And we only do Marriott and Hilton hotels, and at 10% occupancy, we cannot stay in business. On a long-term basis, I absolutely agree with what Ernest was saying, that multifamily isn't going anywhere. It is going to be the staple of the U.S. economy, and with HUD supporting all these businesses, I think it is continuing to grow. On the hospitality side, I'm somewhat concerned as to where the rubber is going to meet the road. I think the CMBS bailout would help. Otherwise, when we were talking to our president of our hospitality division, if no bailout is offered to the hospitality group, we believe that 40 to 60% of the hoteliers will not be able to make the debt payment if this continues for more than 2 to 3 months of poor performance, and does not look like that it's going to be immediate that the occupancy is going to come back. So I'm very, very seriously concerned about hospitality, but very, 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 very comfortable with where the multifamily is.
Thank you very much. Appreciate that. So I read a recent report that showed about 69% of fund managers are reporting a disruption in fundraising. And they also saw about 59% of them saw a decrease in deal origination. Now, obviously, alternatives are expected in 2023, pending, COVID and how long it lasts, to reach about $14 trillion. How do you think that the COVID will impact the underwriting in the real estate market, and what are your thoughts on that? And let's throw that over to Ernest. Go ahead.
Okay.
I think Dr. Bharat, I think Dr. Sangani was about to say something. Go ahead, please.
No, go ahead. I thought it was directed to me, but if you don't speak,
I want to hear your thoughts. Your returns are rather than mine. No, it's definitely impacting. We're looking at deals. We think that even while the number of deals are drying up, we see this as a good time to sharpen our skills and talk to our lenders. We think proceeds from loans are going to be down a little bit, and we're one of the few select sponsors with Freddie Mac, so we get the benefit of pretty aggressive underwriting with them. But we think proceeds are going to go down a little bit, which means more equity is going to go in. We are looking at pretty much no rent increase over the next 12 months. We think people are pretty bruised, and even if the market comes back, we're just thinking it's going to take some settling in time. So we think on our traditional workforce housing fund, we're going to have to underwrite to lower proceeds, flatter rents, but we do think there's going to be good rent increases in the future. We are also underwriting to higher concessions, which is what we mean by maybe people that just have to skip or whatever. So we're being much more conservative in our underwriting to get to the returns that we think we need to get to. We also think we're typically buy, fix, and sell players. We think we're going to be fixing for a little bit longer than our typical 3-year hold period. We think we're going to be looking more in the 4 to 5 year hold period for our underwriting.
Thank you. Does anybody else want to jump in and elaborate on that specific subject, or?
Yeah, I would. This is Dr. Sangani. So underwriting, my only, as I always told you before, I'm just a street-aware guy. I don't know that underwriting truly can exist at this time. I think we have to be very, very careful. It's just like if you want to look at the bottom of the ocean, we go halfway down and we think it's the bottom, we may get surprised. So my only recommendation to the listeners at this time is that I would rather wait and watch. What we have done, we had 3 hospitality deals in the hopper, and we were supposed to buy those. So what we did as a company was to complete, we are still negotiating the PSA, the agreements and everything. So we are saying, let's go get everything negotiated and we'll park it. And whenever the COVID thing goes away, we'll reevaluate at that point. And then since everything has been negotiated, we can then go forward at that point. So it puts me ahead of other people of at least 60 to 90 days of due diligence, because all the due diligence, all the paperwork, everything is ready, except we need to fill in the new price and the signature. So that's one approach we have taken, but I would caution everybody that if you're going to do traditional real estate, this is not the time to really go big time on a single assets. The game belongs to the people with lots of money who are going to trade the debt, who are going to trade the portfolios, who are going to sharpen their pencils and save those REITs. So be careful whatever you do out there.
Yeah, I agree with what Dr. Sangani said and Mike here from RMC. And at the same time, I think I'm going to tie into one of the questions that we received, which is what is the deal acquisition metrics and for Group RMC? And in other words, over the past 3 years, how many deals did we look at versus what we closed? I think this ties very well with the question of underwriting. So, number one, in good times and in bad times. Like, again, we're not investment managers. We're a co-investment group. A large percentage of my net worth during these deals is limited partners alongside other LPs. And we see real estate as something similar to, infrastructure. It's going to be there long after I'm gone, and my kids are going to inherit it one day, and it'll just keep paying income. So it's very important that when we capitalize or when we underwrite a deal, that we do it extremely conservatively in good times, especially in good times for the bad times. Because if it's going to be permanent, you can't risk to ever, giving back the keys is never an option. So number one, I think it's extremely important to underwrite with an enormous amount of cash. And unfortunately, cash is one of the main enemies of IR. And a lot of deals are structured with performance fees, which is fine, but it is a drag on the IRR. So it makes it a little bit more difficult. I think going forward, there's going to be a little bit more of a conservative approach in the underwriting. People are going to have to inject a little bit more cash, which is, by the way, super important in office because tenant improvements and leasing commissions are very expensive, especially TIs require a lot of, you got to do from contractors who have expensive licenses, commercial licenses. So you need a lot of cash reserves. The other thing is maybe go a little bit more long-term, or in your underwriting, give yourself optionality. Don't force yourself to be an exiter at a specific date. The other thing is maybe go a little bit more conservative on your debt. Another way to boost IRRs is have more debt or have interest only. Having maybe some amortization in there could be good as well. Now, to go a little bit more narrow on the question that was asked, Group RMC particular, in the last 3 years, we did about, I would say we closed about 12 to 14 million square feet, which was about $1.5 billion in assets. That's including the debt. We do about $150 to $200 million of equity a year. That's what we deploy. And to what Dr. Sangani and the others have mentioned, there has been a pause because of this pandemic in acquisition. So we're actually not tying down any particular deals right now because you never know how deep it could be. However, I have to say, going back to the amount of cash reserves we have an enormous amount of cash reserves. And one of the companies that I look up to, for instance, was Blackstone. When in 2008, they were very well capitalized, and many people were on the defensive trying to save their assets. Meanwhile, they were on the offense, and they were capitalizing on some amazing deals, and that's when they became huge. I think that the debt markets have squeezed up, have dried up a little bit. CMBS has been kicking the can down the road. Finding debt for your assets is very difficult. But what we're doing is that we're whispering, we're signaling to the market how we could be very discreet buyers to any institution that needs liquidity in a time like this. If you have to sell your asset, it doesn't look very good. Or in some cases, you want to be discreet, and we can be discreet buyers. So if you have cash, like Dr. Sangani was saying, there could be enormous opportunity. Maybe not right now, but in a month or 2 months or 3 months. Because price is a huge factor in risk. And so everything has a price.
Great, thanks. Thank you, Mike. Chris, let me just ask you a quick question. So we were talking, obviously you referenced Dream America, et cetera. Does it change the type of loan structures on the properties that you create, the terms based on COVID and kind of where we are? And I'll put that out to the group, and then we have a bunch of other questions coming in.
Yeah, for us, thankfully, on the financing side, there's no change. We don't finance the properties one by one. We have a commercial line of credit, which we had the good fortune of extending for a couple of years late last year. And it's a floating rate, so in this environment where pricing, LTV is going down and pricing is going up, our pricing is actually going down. Where we do see the big change in our business, which, the reverberations across the debt markets, the mortgage markets, many lenders, due to disruption in the mortgage servicing market, have stepped up their requirements on FHA and VA loans, which are what 1/3 of Americans use to buy their house. And the step up is a step up in FICO score that effectively shuts out many, potential homeowners. The FHA and VA mortgages is the exit for 99% of our clients, so we're monitoring that closely, and we have in turn, tightened our underwriting standards to the best that we can, try to keep people, on a 12-month horizon in terms of when they'll be able to buy the home. And obviously, we're scrutinizing a lot more today than we did before. Not only where does the income come from, but to try to handicap, is that at risk? Our clients are nurses, truck drivers, police officers, postal workers. I mean, a lot of people who are on the front line. So for many of them, their income isn't at risk, but their health is at risk. And obviously that directly impacts your income if your health is at risk. So no one's immune from this.
So we had a question, Chris, that came in also that was somewhat similar to the loan conversation that you just had about construction loans, though, and lending activity, specifically hotels in Miami. Obviously, Chris, that's not part of your scope, but
actually, I'm part of a group that owns a hotel in Miami.
Oh, look at that. All right, so I throw it out to the group. If you can maybe talk specifically, the specific question came in about hotels in Miami, construction loans and lending activity there, so maybe we could touch upon that.
Yeah, look, I think Miami, unfortunately, is going to be in for a rough ride. Everybody knows that tourism is a big part of the economy here. The hotel business obviously depends not only on the, vacationer, but also on the business conference. And just as we're doing this conference today virtually, I have to believe that that's something that more and more people are going to look at, even as restrictions are lifted. Or you're going to see, what you see anyway in a recession, forget COVID, fewer business conferences. I mean, I remember coming down here before I lived here in 08 and 09, and the guy who picked me up at the airport to bring me to my house here, I asked him how his business. He said, "You're the only trip all week." So, unfortunately, once the restrictions are lifted, I don't think that's not going to be a quick snapback, as Doc was saying. And on the hospitality front, it's a big question mark.
Yeah, a question for the group. So how long do you think it'll be until we start to see some real estate prices drop, within the different geographic regions? And are there specific targeted regions that you think will be hit harder than others?
I think they started dropping about 45 days ago. No, seriously. I mean, I think sellers have fallen into two categories broadly. I think the people that have the means to hold on through these rougher times, maybe they have lower leverage, they have a good quality tenant mix, they're in a sector that's, performing well, such as the single family homes and others, they're going to be fine. If you don't have to sell right now because of loan covenants or other equity, and you can hold on through this, you're going to be okay. You don't need to do pricing adjustments. But if you've got short-term debt that's coming due, if you have a bridge loan, if you're at the end of if there's some reason you have to sell right now, it goes back to what Dr. Sangini said. It is very hard to underwrite something, and you're going to underwrite it to the extreme worst case, and you're going to get hit pretty hard. We were looking at some deals, and we passed on them. We had them, closed under contract, and like Dr. Sangini said, we have them kind of on hold now, but we did get some price adjustments for the unknown and for some timing that might occur. So I think it's happening. For the sellers that have to sell, there are price adjustments. For those that can hold on, I don't think they're going to be subject to the price adjustments.
Dr. Sangini, question came in, and I want to propose it to you. So the question that came in said, can you advise or further elaborate on what you meant by the CMBS bailout? The Feds say that they will buy AAA-rated CMBS bonds, but the question proposes that does next to nothing for individual buyers.
Yes. Let me first address the construction side, because I think I have a different information that a lot of people get surprised when I tell them. As we were just talking, we have about $300+ million worth of construction going on across the nation. And one thing that has happened is almost every state has kept construction as an essential service. So we have not had one single day of drop in our construction. So construction is going as if nothing has happened. And then that's the good news on one side. So I think the delivery of the buildings will be on time. Whether the construction prices will impact because there will be less debt, that needs to be seen. But we are safe from whatever is under construction is going well. Coming back to this main question that is being asked with CMBS, it's not only AAA rated debt is going to be bailed out, but Trump, and listen, I want to stay apolitical as much as anybody wants to be, but if there was any time, if I wanted a president who was a businessman and then more so in the hospitality, this is the time I would want one. So I think this is not a no-brainer. This is no-brainer for him. He exactly understands. So a couple of statements I read from him is that he understands and he's going to somehow figure it out how to bail out, even though they are not high-graded, AAA rated corporate bonds, just plain CMBS vanilla debt, whether or not it will percolate down to the customer like us who actually make the payment, or would it stop at the lender level? But even if he stops in the lender level, he will make the lender level make sure that they don't put the onus on the customer like us to make the payment as well as get the bailout. So if you do get the bailout, people like us who have to make monthly payment, there'll be some deferral or some kind of adjustment. And as I said before, if that doesn't happen, just count on this: 40 to 60% of all the hotels in this country will be for sale because you just can't stay long enough. Just like Ernest said, it will divide into three groups. The number one group is the REITs, which has to maintain certain leverage, and they have certain credit lines, and when the values drop by 50%, those papers, those stocks will be beat so badly that the paper would be heavier than the stock value. And it is happening. We are seeing that already. So that also answers the other question: has the price been impacted? The price on individual sales hasn't been impacted, but the price of the multifamily, price of the hospitality REITs are down in dungeons. And then if somebody can really make a good play, that would be I would find a good REIT that I trust, believe, and buy at this price. The middle group is like us, right? We are somewhere around few $1 billion. We are not big enough. Like Blackstone over the weekend put a $2.3 billion distressed asset fund in less than 48 hours, and now they're going to gobble up dollars for the value of, cents for the values of dollars. We just can't do that. So we will fall into the middle group. We'll have to either buy few assets or one asset, and that is literally further out, and that is the one I'm talking about, how it will be impacted by what our government does for the CMBS bailout. And the SMA and PA, as Ernest perfectly mentioned, if they have enough cushion, they will fire everybody, they will run the hotel by themselves and wait for good days to come, and everything will be fine. If they just can't survive that long, then there'll be a terrible situation in that group. So divide into three groups and then think differently to where you fit.
Thank you for that perspective. I appreciate it. We also received an interesting question from Sean, and he references Morgan Stanley CEO recently acknowledged changing commercial office landscape as obviously more and more people across not only the country but the globe start to work from home. And obviously, there's the thoughts there about reducing office footprint. What are your thoughts on that? Maybe we can send that over to Ernest and see what your thoughts are with the footprints being reduced in the future for office space, et cetera. What do you gentlemen think?
Well, again, a lot of my background is in office space, and I've seen this coming and going over the years where, people working in cubicles, people working in offices. There's a study out about 6 months ago that, working in cubicles has been a bit of a failure, the open office concept. So I really don't know. I do think, though, that people are enjoying, to some extent, working at home, despite my joke about people wanting to get back to the office. But I don't know if it's going to drastically reduce the amount of office space. My son worked for a commercial real estate firm that not only had an open cubicle farm, but you weren't even assigned a cubicle. You just kind of went and checked one out every day, and everybody hated it. They hated to go to the office. They wanted a place to work. So, I think we're going to go back to the model again. I could be wrong, but I just think that we've shrunk the space per person as much as we can. If anything, I think we're going to be looking at distancing a little more if this holds true, that we want a little more space to work. So I just don't think it's going to have that much of an impact on the per user office space. I think what's going to really be impacted in the short run is the small businesses that are just going out of business. And I'm here in Houston, and we've got about a 25% vacancy, maybe more so in the energy corridor. And I don't know when that space is going to recover. So I think it's kind of two stories. I think overall office occupancy is going to go down because there may be fewer users. But I think the space per user is going to be good, and I think also that you're going to see more companies creating different types of spaces for their users, and that's going to take more space to attract workers back. So, it's the jury's out, but I don't think we're just going to massively have everybody start working from home. I think that sounds good in science fiction, but it doesn't work in fact.
Mike, any thoughts on that?
Yeah. Well, I think that's an excellent question by Sean, and I saw that report as well. I'll give a couple of anecdotes from the field that even surprised me, and the echo what Ernest was saying too. There's a large tenant of ours, to remain nameless, but it's in the aerospace company industry, and they just expanded their lease by 25,000 square feet, which is pretty big, because in their policy they're going to need more social distancing measures. And a specific amount of space between employees. So I like hearing what Ernest was saying, because I was thinking about it too. And there is going to be potentially a pendulum swing back towards a situation where people have their own space to work. There was a lot of movement towards like co-working, co-sharing space, where people at big law firms or accounting firms, they could one day work in a cafe in their office, and the other day, book a room. And the reality is, and this comes from a lot of my colleagues as well, who don't work at RMC but for different companies, either partners at accounting firms. They're hearing a lot of cross-pollination of germs and whatnot, and so now we're going to be a lot more sensitive to this. And it was a way to reduce a lot of space and costs in real estate. Even though it was nicer and supposed to make employees happier, it is a way to reduce costs and space. So there's going to be a pendulum swing back, we think, to the traditional workspace, which does take a bit more space. Now, another thing that I have to say, and a lot of companies that we've been talking to, they very much said that if they want to have any culture in their company and maintain a specific culture, a good culture in their company, they're going to need to have workspace. Now, I do think that smaller tenants where rent is very important, it's probably a difference between solvency and insolvency, they're going to for sure work from home. But for larger tenants that think about corporate culture, productivity, I think it's very important to have good workspace where people feel good about going to work and working together as a team. And the last thing is that there's been a lot of research on productivity and morale, and doesn't bode too well if you're working specifically from home. With the kids at home and daycare and all that stuff. So just a couple of things from the field, but very, very good question.
Mike, thank you. Thank you for your insight. So we only have about 5 minutes left, so I want to just kind of get through a couple of questions and maybe really a short-term answer. And one of the questions that came in from Tyler was, what do you think we can expect to see more over-leveraged multifamily owners start to default, and how much leeway do you think that they're going to have within the market? I propose that to the group.
So first if I can take that, go ahead, Ernest.
Go ahead. No, please go ahead.
So if I have to take that, then I'll take it from the Class A space that I normally represent. I directly relate this to the length, how long it will take to open up. If in my mind, every week of delay is 1 month. So if we hang on another 4 weeks from today, then it's 4 months. And I think any time it will go beyond 6 months, I think it will be very, very difficult to recoup that. So just directly proportionate to the amount of time we don't go back to work. I think that's how my simple, again, the street awareness formula.
This is Ernest. I agree with that. I think just if you do the math, if you're a borrower, you get 30 days free anyway before default proceedings start. And if they do start, the courts are so backed up right now, it'd be hard to get an owner into that position. So I think the lender may hold that note for a while and then maybe sell it. Then you have, if you're under Fannie and Freddie or some of the federal loans, you may get the 3-month forbearance. So I agree with what you're saying. Guinea said, I think, his is from a practical standpoint when people go back to work. Mine is from the mathematical standpoint. You're probably looking at 5 to 6 months before things really start loosening up. And I think that's when we're back at whatever the new normal workforce is.
Thank you. Let's take one more. So let's just answer one more question. And I'm hoping that we can go straight down the list. Chris, I'll propose this to you first. So in your opinion, what do you think is the top market that it'll be impacted? And then what do you think is the top market that will be least impacted in the real estate sector?
Yeah, I mean, that's a tricky one depending upon which asset class you're focusing on. For us, we have been focusing on markets like Atlanta Metro, which is our biggest market, that are benefiting away from high-cost cities. So places like, unfortunately, where I lived for many years, New York City, are being very hard hit by this. And, measures that the city council or others may take. I saw a proposal today similar to the question about LA, where they're wanting to put off evictions for a year, just make it less and less landlord friendly. So I think that's going to be really tough for investors. And I think they're going to look for, just as companies are going to look for, where can they move their workforce to that are lower cost. And that's really benefited the markets that we focused on in the Southeast and elsewhere. And I think that trend that already began is going to continue. So,
Mike, thank you, Chris. Mike, your quick thoughts?
I actually echo them. I think deals that have less cash flow or were tighter in their underwriting, traditionally the ones that were more expensive, like in CBD markets, I think will be the first to be in the red. Of course, if you lose just a few tenants, you're in the red. If you're a low cap rate, and those tend to be in more expensive markets. So that's what I think in general.
Thank you, Dr. Sangani, and then Ernest, and then we're going to need to conclude the session.
Yeah, thank you. So again, mine is a street-aware kind of answer and simple, like it kind of KISS principle. Listen, look at the number of deaths. Any area there is a high number of deaths is going to take much longer. Any area that is a low number of deaths, I don't think it's going to impact it that much. So if you really want a simple formula, where do you want to land, then just follow the number of deaths across the nation. And if you can swallow that and then make your plans, I think you will be safe.
Thank you.
It's Ernest. Yeah, it's Ernest. I think the markets are going to recover, and I'll speak a little more general, but I'll cite some markets specifically. I think Orlando, Jacksonville, and the Carolinas are going to recover pretty quick, and people will probably be shocked at Orlando, but again, I think people's basic instincts, they still want to take a vacation, and all the kids are going to want to go to Orlando. They don't understand the COVID. I think it's going to be a safe place. I think Disney's going to pump a lot of money into that economy and the hotels down there to get it reactivated. I think you're going to see airfares cheapen to Orlando. I think there's going to really be a big economic driver for tourism. And again, that's just my thought. Jacksonville I like because there is a huge medical research center in the Jacksonville area, and it's a major port for product coming in. And I think anywhere where there's a medical research sector is going to be driving jobs. And I think the Carolinas, because I think they're just so well managed and they tend to respond well to downturns of the economy. And it's a great place to live. And I'm not from there. I'm just telling you, I just think that the markets that'll hurt, I think New York, because of, it's not going to go away, but there's a reason there's that many deaths, as Dr. Sangini said, in that area. The closeness to people living together, I think maybe people are just going to say, I've had enough of this. I think Hawaii is going to suffer a little bit because it is so tourist driven and it is so expensive to get there. And I think Vegas, because it's not as much of a family play. And I think as people are looking at their cash and counting their coins, maybe gambling is not the place to be. And I don't say that because I dislike gambling. It's just kind of my quick reads on things.
I just want to thank everybody very much for attending today's session. on behalf of all of our panelists, really appreciate it. Hopefully you thought that there was a lot of value in what we provided. And Mike, let me pass it over to you. I know that you'll be proceeding to present your views.
Nick, thank you very much. Thank you to Circle Partners for being members of FLIA and Dream America and ApexOne and Group RMC and Encore, all members of FLIA. I had the pleasure to get to know each of these gentlemen extremely well. And, you know, if you haven't checked the marketplace to look into the opportunities that their respective firms offer, I encourage you to register and to check the marketplace out. The easy way to get there is flaia.org, FLAIA.org, or straight to the marketplace at marketplace.flaia.org. What an excellent panel. Appreciate the frank talk back and forth, discussing the issues, and, you know, offering honest perspectives in the space. It was a great panel. And again, guys, thank you very much for doing that. I'm going to fast forward here. If you haven't registered for part 3 of this discussion, it'll be a 2-day discussion. On May 19th and 20th, we will put the registration link inside of the chat box. Please take a moment to register. We will be providing a follow-up to all of the panels. And I encourage you, if you're looking for some of the slides or their presentations, or if you want to book a meeting with any of the speakers today, there will be a link on the follow-up page next to each of their names where you can download their presentations. You can also book an appointment directly with them. So, moving along, Paula Soriano, she's a top producer in the real estate space. I want to thank her and thank Sotheby's International for being a member and sponsoring this event. Here's a little snapshot of our marketplace, which we'll be getting into soon. Really quickly, we have 3 upcoming webcasts. Off the Chain Capital, excellent firm, really good returns. Brian Este is the Chief Investment Officer there. We'll be presenting on May 7th at 1 p.m. If you haven't registered, we will also provide you with the link to all 3 of these webcasts for you to register. On the 14th, Hedge Act, Michael Griffin, who will be speaking after my presentation, will be doing a presentation on litigation finance. And the title of his presentation is Generating a Steady Yield from America's Retirement Surge. On May 18th, we have Rafael Serrano, the founder and managing director of Safe Harbor Equity. He will be discussing evaluating distressed debt in commercial real estate arena, in the commercial real estate arena. His webcast will be on May 18th at 1 p.m. All of the webcasts are 1 hour, and we hope that the people here today take the time to register and attend. With that said, FLIA will be releasing a distressed asset marketplace, so please keep your eyes open for communication on it, which brings me to my presentation.